Hello, welcome to week 37. It is the 12th of September. My name is James Kim, one of the sales traders here in Sydney, recording live from Australia in Asia Pacific. This week we're going to be looking at our usual instruments in the currency space. We'll look at the US dollar index, the euro, the cable, the Aussie dollar, followed by the dollar yen. With the indices, we'll look at some levels over the Nikkei Futures, followed by Hang Seng, Index CFD, the CFD over the S&P 500 and the Aussie 200 Index CFD. In terms of commodities, we'll be focusing on copper and gold for the week. The US dollar index continues to be supported along the lower channel trend line, which we've marked for several weeks now, and we continue to work with this as strong support. Now, despite the US dollar trading through the lower trend line once last week, no settlement has occurred below here for now, so we treat the violation of the trend line last week as a false break. Note that 2 settlements or more below the lower trend line is required to signify a true break. So we target the 200 DMA again this week, and given the continued support the US dollar has received along the lower trend line, gains are more likely than not. And above the 200 DMA, we mark in the 76.4% retracement level between the July highs through to August lows, which comes in at 96.78. Now this level here at 96.78 happens to come in, interestingly enough, if we look at the weekly chart, just below a trend line that connects the November highs through to this is high. So we do look for the US dollar to pause around these areas here. So for those US dollar bulls out there, this is a level to be watching for the US dollar to potentially pause before seeing a bit of a retracement lower. An attempted rally last week over the euro was met with a rejection at this orange trend line, which connects the May high through to the highs in August. Given the technical setup over the US dollar index though, which is tipped to be bullish, we look for a lower retracement this week for over the euro. Our support zones this week remains consistent from the week before. The halfway retrace mark between the June lows through to August highs at 111.38, which is exactly where the 200 DMA is trading at today. Any rise over the euro this week should find selling upon it testing the orange trend line here. Now, we got that initial higher move out of the cable as expected last week, only to see those gains fizzle away and more as it settles slightly lower for the week. The cable now approaches an interesting level, and it already has bounced up off this upper trend line here, which connects the June swing highs through to July and August swing highs. So we mark this zone here between this trend line that it broke above and this green rising trend line here as strong support zones over the cable. Now, should this zone hold as support over the cable, this would be interpreted as a short-term bullish development. We'll first aim for the cable to retest at least last week's high around these levels here, and a break above here would have additional upside risk, and we expect gains to extend to 135.48 around these levels here, close to this swing high, and we expect the market to have completed its upside move at these levels here. That level has been derived by applying an extension from the post-Brexit lows to the first swing highs and applied to the lower swing, a higher swing low, and 100% extension comes in exactly at 135.48. And the Aussie just cannot catch a break, with it being rejected just below the August highs and at levels where it's receiving some decent selling. So we all know where the popular sell levels are for the AUD. On a continued lower move, we aim for this red trend line here to be a short-term temporary support level, and erosion here will turn the focus to a retest of this orange trend line, which happens to be levels where the Aussie has enjoyed some traffic in the past, and these levels here for the week comes in around the 74 handle. The dollar yen continues to be caught in a channel, and only a break above this channel would be necessary to argue for that longer term bullish shift. So a test is obvious this week. It is this upper channel trend line, which is expected to act yet again as dollar yen's resistance, and a break above the channel introduces scope for the dollar yen to test the same levels as we marked last week. We first aim for 104.90 in the short term, followed by the 106 handle, with the opportunity for a retracement may develop. Now the Nikkei struggled in maintaining its recent gains last week, as it traded against those noisy areas we highlighted in last week's presentation. Furthermore, the settlement below the 200 DMA is a near-term negative. However, a further push higher is possible should we get that channel breakout over the dollar yen, as I mentioned in the previous chart. Support this week has already come in upon this green trend line, which connects June lows through to July swing lows here. First, the resistance is expected at 16,940. Above here, last week's swing high would be the level that may yet again challenge Nikkei's rise. The high over the Hang Seng last week came in at exactly the 76.4% inverse head and shoulder extension level, and given the pullback it received off this extension level, a retracement lower is expected this week, which we're already seeing here in Asia, and also given the weeklies from Friday, this should allow the Hang Seng to retrace lower. Initially, last week's low of 23,506 should have been the first support, which is breached today. We look for a gap fill at 23,329, and for the market to be supported here down to 23,145. Now we're finally seeing some action out of US equities, with last week ending lower with a sizable move. Now whilst the US 500 ended on its knees, its close happens to come in line with the highs of 2015 and also the pre-Brexit highs, and where it is currently trading here in Asia is pretty much still at those levels, slightly lower than Friday. Now given these levels have acted as tough resistance in the past, we don't see US equities giving up that easily, so we cannot discount a temporary bounce from here, and given that we are currently trading at what, as I mentioned, was a previous heavy resistance level, we mark some extreme levels to the top side. First level to consider a short position upon a higher retracement is at 2160 down to 2155, so we target the zones between 2155 to 2160, above that at 2173 as levels to add to any of the short positions taken on a bounce. Any positions, short positions initiated this week would have stops above 2193, the 2016 highs. Upon a lower move, we first mark support upon a test of this green trend line here. Below here, the next ultimate support would be eyed at the 200 DMA at 2055, but we're talking some extreme moves here before we can get there. Again, another week of underperformance seen in our Aussie index last week, and also today at the close on Monday. Now given that we've moved well ahead in losses, it should not come as a surprise should our index holds our gains, or our losses, sorry, relative to US equities in the coming trading sessions. So after forming a double top formation, the Aussie index has continued to slide away, breaking through key levels that should have held. Today on the close here, it's closed right on its 200 DMA, and depending on how we trade tomorrow, if we are supported above here, we are looking at a technical bounce over the Aussie 200 index. So upon a higher retracement, we set resistance at 51.30 and set sell levels over the Aussie index at 53.90. Upon a lower move below here, we are targeting the end of June swing lows at 50.36. Copper in the past week could not get even close to the 200 DMA, and this 200 daily moving average remains yet again as topside resistance this week. Now copper's anticipated move lower to test the purple trend line here is just a matter of time, and again the bigger test that awaits copper is upon it testing the multi-year trend line, which starts in 2002. Again, we are continuing to see a decline in momentum. Gains over gold last week were capped as it approached the higher orange trend line, which connects the 2016 high through to the first swing high in August. And any high retracements over gold this week should be met with selling here. On a move lower, we continue to work with the trend line from December 2015, which connects through January lows through to May's lows, and this comes in this week around the 1300 level. Now again, a lower move to these levels will be greeted with the 200 weekly moving average, which sits this week at 1287. So any downside moves over gold, we are looking at a gold slide to be potentially arrested around these levels. Thank you for joining us on this presentation. Wishing everyone a fruitful and profitable trading week ahead. Thank you.